welcome back to Financial Focus Radio. Thank you for joining us. We're going to do one of those e-newsletters next week, talking about whatever's going on in the market. So if you want to get signed up for that, go to our website and get on that list. This is pretty interesting, and this is what Josh talked about in the first segment with regards to the breadth of the market. So there's the market, and remember the market is market cap weighted, meaning the bigger you are in terms of a company, the more influence you have on the index. So the biggest names in the index make up more than 20% of it from a performance standpoint. So those 5 names that are huge, that you know what they are, the FANGs, they influence the performance of the market, and they've obviously done very well, and that's meaning why the market's done so well. But according to By the Numbers Research, even though 35% of the stocks in the S&P 500 are down at least 20% year-to-date through Friday, July 31st, the cap-weighted index is up 2.4% year-to-date. So how could that be? Most of the index, or 35% of the index, is down at least 35%. There are stocks in the index that are still down 50+%, the airlines, those kind of names. And so how can the index be up so much? Well, Apple, guess what, everybody, has a $1.87 trillion with a T market cap. So obviously how Apple does, so goes the index. How Facebook, Apple, Google, Amazon, how they do determines how the index does. And they reported earnings, and they blew earnings out, and so their stocks ripped, and that's why the S&P is doing so well. To give you some perspective on Apple's market cap at $1.87 trillion, the GDP of India with 1.3 billion people is 1.9 trillion. So Apple is about the same size as the GDP of India, which is it's bigger than Russia. I mean, it's bigger than some large land masses, and it's a company here in the United States. It's crazy.
Well, Apple's up 52% year to date. You can look on a granular level amongst ETFs, so that's good for essentially 2.5% of the S&P.
Yeah, it's crazy, crazy. Before we talk about the 60-40 model, this is some more interesting data. By the end of 1980, 6 of the top 10 companies by market cap, so 6 of the 10 biggest companies in the U.S., were energy-related, as one-third of the S&P, as was one-third of the S&P. So if you go back to 1980, most of the bigger names in the index were energy-related stocks. So you think of the ExxonMobils of the world, the Chevrons of the world. Today's things couldn't be more different. By the end of March, the energy component of the S&P 500 hit 2.8%, meaning all of the companies that are in the S&P 500 that are energy companies only make up 2.8% of the index, which is an all-time low by quite a bit. So it is crazy. It also goes to show you why you need to diversify. You never know sort of what the future is going to hold. The names that make up the index today aren't going to be the leaders a decade or 2 decades from now.
And hard times to come in the oil patch. I know Exxon stopped 401k matching this week, and word is that the dividend may be next.
Yeah, the dividend is sort of sacrosanct with these energy names, but I think they're going to be forced to cut a lot of those dividends, which is what makes the investment thesis for a lot of investors that are in those names, Exxon and
when
the
they
Chevrons.
cut that, it's going to have to leave a lot of the income funds, and it just starts this negative feedback loop.
It's not good. But our point is, a lot of you are buying these FANG stocks as no-brainer. I can hold these names forever. And history would tell you that that's a very, very dangerous thing to do. All right, let's talk about rethinking the 60-40 portfolio. So let's describe what it is first. The 60-40 portfolio, for ease sake, in describing it, you would have 60% of your money in, let's say, the S&P 500 and 40% of your money in the aggregate bond index. The way that we think of a 60-40 portfolio, the 60% has some percent in large cap, some percent in mid, some percent in small. We actually go out and buy ETFs that express that as a percentage of the portfolio, some percent in international, some percent in emerging markets, REITs, and so on. So we diversify that 60% that's in stocks. And then on the bond side, right now, we're exclusively invested in treasuries, between short duration treasuries and TIPS. But that's how we look at the 60-40 portfolio. And so for a long time, the 60-40 portfolio for retirees was sort of a no-brainer. Set it and forget it. It worked really well because interest rates were, north of 5% on the bond side of your portfolio. That provided great ballast and income. And when stocks were down, the stock or the bond part of your portfolio held up really well. Well, here we are today with the 10-year Treasury at 55 basis points. And so the 40% that you may have in bonds is yielding in real returns negative yields, meaning, so there's a bunch of your money that is negative. So our take on rethinking it, if you're an investor or a retiree, is this is a scary thing for me to say for you, I know, but is to increase your equity exposure, but increase it in parts of the equity markets that are less correlated with the large cap stocks that are so prevalent in the market right now. So look in the parts of the market that are undervalued. So international, whether it's developed international or emerging markets, those markets are cheap relative to the United States, and so that's a place to look. Especially if we continue stimulus in the United States and the dollar weakens, those markets will do really well as an American investor. Small cap is the cheapest it's ever been relative to large cap in my lifetime and Josh's lifetime, so that's another place to look. REITs might be another, publicly traded REITs might be another place to look. And so there are parts of the U.S. market where you can increase your equity exposure. So if you're normally a 60-40 portfolio person, you might say, okay, I'm going to be 70-30 or 75-25 because that's the only place I'm going to get return from my portfolio. But I can't shovel it all into large cap S&P type proxies. And I think that's what we're talking about when we think people need to rethink their 60-40 portfolio for retirees, is the 60-40 isn't really going to do it right now because bond yields are so low.
That being said, how many times over the duration of your career has the death of the 60-40 portfolio been proclaimed?
Since it's every year since I started. But here's the difference. We've never had a 10-year at 55 basis points. Most of my career, the 10-year was north of 4%. The 100-year average on the 10 years is 6%. And so if you're at somewhere between 4 and 6% in most of your bond, and you can buy high yield and you can buy corporate where your bond income is 6%.
For those that aren't ready to accept that level of volatility in retirement, though, the 60-40 may still provide some sort of, it's the fixed income component of that portfolio is really just a diversifier, and it's not going to add any sort of positive real return. But if you allocate that 40% correctly and you own short duration treasuries, it's going to have a negative correlation to equities. And it's really just a time, if you're using an advisor or managing it on your own, you can tactically rebalance into stocks when they provide.
And if you're taking income, you kind of need it there.
Yeah,
that's
you absolutely need it.
But
there.
if you're not, if you're in the accumulation phase, our point would be maybe not so much in bonds because, but it doesn't mean shuttle the money from the bonds to large cap U.S. stocks. It means shuttle the money to other parts of the stock market that are undervalued relative to U.S. large cap as a diversifier. And I think that will longer term serve you well. So rethink that 60-40 portfolio. I don't think there's many options for you. Those either retired and taking income. But if you're an accumulator, meaning you're not retired yet, you're still piling money in, rethink maybe having so much allocated to bonds because real returns on that side of your portfolio are negative. And I'm sorry, I don't think that's going to change anytime soon. All right, if you want to be part of the show, give us a call, 877-670-7117, or go to our website, financialfocusradio.com. When we come back, we're going to tackle some of your email questions, so stick around.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial.